how the how the bank is going to borrow the money. If the bank decides to borrow the money from the RBI, then it is having three routes to borrow the money from the RBI. That is, one route is repo rate route, the second route is bank rate route, or the third route is MSF route or marginal standing facility route. So, under what route the bank going to get the money means it is decided based on the purpose for which the bank needs the money. Based on the purpose for which the bank needs the money, the bank will select the route. Suppose, for example, if the bank needs the money to match the temporary mismatches in the cashing issue. Suppose there is a very temporary issue for 1 day or 1 week or 2 weeks. It is very temporary term. There is a cash mismatch in the book. In that case, the bank will choose the repo rate route. Suppose if the bank wants to expand its business means it wants to lend to the more consumer. It wants to lend to the more consumer means it needs more money so that it can lend. So it will take loan from the RBI, and loan means generally it is a long term. It is not like a repo. It is for the short term. Loan means it will be for the long term. Therefore, in this case, when it wants to take a loan, then it will use a route known as bank rate route. Suppose if it wants more fund for the short term or the emergency situation or for the overnight situation, first it will try to use the repo rate. If the repo quota is exhausted, then what it will do? It will try to borrow from the friends. Friends means the bank will try to borrow from the other banks by interbank rate. What is this interbank rate? I will explain you later. Just as of now, you remember like this. It will borrow from its friends, that is other banks. But it is also not possible. Then as a last resort, it will try to use this MSF route from the RBI. It is the last resort route used by the RBI for the temporary or overnight cash mismatch. So based on the purpose, the bank will decide what route it will select. Now, I will explain you what is this repo MSF bank route clearly. I hope the concept behind the repo bank rate and MSF is clear. Now I will tell you the technical details with related to each of them. So first we will begin with repo. Repo means repurchase option rate. Full form of repo is nothing but repurchase option rate. As you all know this, repo is the bank uses the repo only for the short term or overnight cash mismatch. It is not going to take loan or long term under the repo. So what is this repo means? Suppose here there is one bank is here and bank need, let's take 1 lakh rupees to manage the immediate, for the next 1 week it needs the 1 lakh rupees to manage the cash issues. So what it will do, it will approach the Reserve Bank of India and ask the Reserve Bank of RBI, please give me 1 lakh rupees. I will return you this 1 lakh rupees after the 1 week because I am having some fund current situation. Then what the RBI will tell? RBI will be telling that okay, I will give you the 1 lakh rupees, but I need some collateral. That is, I need some securities so that I can give you 1 lakh rupees. Therefore, what this bank will do? Bank wants 1 lakh, so bank will provide securities. Securities like government securities, bonds, like this worth 1 lakh to the RBI with the repurchase agreement. I will use the short form repo. Repurchase agreement to the RBI that I will give you 1 lakh rupees worth securities. You give me 1 lakh rupees and I am promising you that after 1 week of time, I will repurchase this government securities from you. And this is the repurchase agreement. So what the RBI will do? RBI will extend 1 lakh rupees to the bank. After 1 week, what will happen? The bank will go to the RBI and based on the repurchase agreement, will repurchases this government securities or securities which it provided to the RBI. And what the RBI will do, as you all know this, repo there should be some interest because RBI can't give free to the bank. So RBI will charge some interest. Let's keep 10% or 10% is the interest means when giving back the security, RBI will charge and collect 10% interest from the bank. I'm telling 10% as a random number, but whatever interest rate it is charging, the technical name of the interest rate is known as the repo rate. The technical name of the interest rate is known as the repo rate. Therefore, RBI will charge the repo rate on this transaction. So this is nothing but repo rate. Therefore, repo rate is for the as you all know this, repo rate is for the short-term interest rate. The technical term for the short-term interest rate is repo rate. It is charged by RBI on its client. And this repo has been introduced during 2000. During the year 2000, the repo has been introduced. And currently, the repo has been available for the tenure of 7 days, 14 days, or 1 to 28 days. Suppose if the bank wants money, means it can borrow for 7 days, or 14 days, or 28 days under the repo rate. And recently, RBI even introduced the term long-term repo. Long-term repo means the repo operation, instead of for overnight or 1 day or 2 day, it has been introduced for up to 3 years, but it is a temporary facilities. Because you might be thinking, it is only for the temporary cash mismatches, right? For the long term, it is going for the bank rate. Then why it is introducing 3 years facility means it is a temporary facility, because during the COVID times, many of the firms, many of the shop needs money to keep running their businesses. So to match that, the temporary financial crisis, it introduced a long-term repo for the temporary facility. So this is the repo. Under repo, the bank can borrow by giving the collateral or G security. Now we will see what is the bank rate. As you all know this, bank rate, the bank will take the loan from the RBI for the long term. Correct. Here the borrowing is for the long term. For the repo, it is for the short term. And here the bank borrows from the RBI to expand its business, or whatever money it is getting by the RBI under the bank rate, it will lend to the consumers and the bank will get the profit out of this. So this is the concept of bank rate. For using this bank rate, the bank no need to keep any collateral. Unlike the repo, where it has to keep the government securities or securities as a collateral, in bank rate, bank no need to keep any collateral with the RBI. And there is no repurchase agreements like the repo rate. And one more disadvantage with the bank rate is the technical term of the interest rate charged by the RBI and the bank is known as bank rate. And it is different from the repo rate. The repo rate is lesser. The repo rate is lesser than the bank rate. Therefore, interest rate when taking the loan by the bank rate is more compared to the choosing the route of repo. So this is the bank rate. Now coming to the third concept, that is the emergency last resort concept, that is MSF. MSF is known as marginal standing facility. As you all know this, in the repo operation, when getting the money from the RBI will dip, or RBI will pledge, during the repo, I'm sorry for the technical term, during the repo operation, when the bank wants to get the money from the RBI, it will pledges, or it will gives the collateral, or it will keeps the collateral, that is G securities or securities with the RBI. But these G securities are outside the reserve requirements. For example, 1000 rupees the bank is having, or let's say 10,000 or 1 lakh rupees the bank is having, means out of this 10% it has to keep as a reserve. For example, out of this 1 lakh rupees, let's keep a simple number like 10% it has to keep as a reserve, means remaining 90,000 it can't touch this 1000 rupees as pledging to the RBI. That is, the reserves is 1000 rupees and remaining 99,000 or some amount is there. I will give you a simple example so that it will be easy to understand. Okay, let's keep the bank is having, let's say 100 rupees and 10% is a reserve requirements, means 10 rupees it has to keep as a reserves. Because my max is very weak, so please I'm keeping a simple number. 100 rupees means 10 rupees is a reserve and 90 rupees it can lend, means this 10 rupees it can't pledge this 10 rupees in the repo. It will pledge the government securities out of this reserve as a securities. So in the under the repo, it can get any money it wants from the RBI unless and until it is having securities or collateral to pledge. Suppose if it is having 10,000 rupees worth securities, means out of the reserves, then it can pledge the entire 10,000 rupees and it can get the 10,000 from the RBI. If it is having 1 lakh rupees outside the reserve, means it can pledge the 1 lakh rupees and it can get 1 lakh from the RBI. But it can't pledge the securities which it kept under the reserves. So the reserve is reserve. So you know this, if the bank is having any cash crunch for the emergency or for the short term needs, means first it will tap the repo function. If the repo is exhausted, means then only it is going to come to the MSF. Wait a minute. Only when the repo is exhausted means it is going to come to the MSF. When the bank wants to take the loan in the form of MSF from the RBI, then it has to pledge some collateral to the RBI. It has to pledge some collateral to the RBI, correct? But already all the collateral have been pledged by the repo. So only the repo will be exhausted. If the collateral or the government securities is there outside the reserve, means why it is going to come to the MSF? It can use this collateral by the repo and it can get the money from the repo route itself. Correct. Since all the collateral outside the reserves are exhausted by the repo route, so only it is coming to the MSF route. So when it is coming to the MSF route like this, then how the bank will borrow the money from the RBI? Because RBI will be demanding certain collaterals, right? So for this, the RBI allows the bank to dip or to pledge the collateral from the SLR. You know that reserves contains CRR, cash reserve ratio, and SLR. Both are this form of the reserve, and out of this reserves, whatever is there, whatever G securities or securities are there, they will pledge this for the repo, and they won't during the repo they won't use the reserves. But in the MSF, the RBI allows the bank to use the reserve. That is, RBI can pledge this SLR to get the loan. Suppose bank can give the SLR to the RBI, and RBI will give back the money to the bank. Under this also some rules is there. How much money the bank can get by the SLR route means only up to 1% of the NTTL. NTTL means it is nothing but net demand and time liabilities of the bank. Suppose if the bank is here means two persons are depositing money. For example, let's keep two persons deposits, let's say 100 rupees and 100 rupees like this. And both are 100 rupees is in time liabilities and 100 rupees is in demand liabilities. Time liability means it is a fixed deposit. Demand liability means it is savings. So totally 200 rupees is there in the form of demand and time liabilities. Out of this 200 rupees, only 1%, that is 2 rupees, the bank can avail from the RBI by using the MSF by dipping the SLR. I hope the concept of MSF is clear. MSF is the extraordinary or emergency route when the repo or all the securities outside the reserves are exhausted. Then it can tap the reserves, that is SLR, and that too only 1% of the NTTL it can borrow from the RBI for the short term. Therefore, it is an emergency or overnight situation. It is a borrowing tool in addition to the repo, and it pledges the reserves, that is SLR, and it can borrow only up to 1% of the NTTL. During the corona time, the government allowed that the banks can pledge up to 2% or 3% of the NTTL. They can borrow 2 or 3% of the NTTL because during the corona time, many businesses are shut. Bank wants more money to lend to this consumer. So only during the corona time, the bank allowed 2% or 3% of the NTTL you can borrow. But again, after the corona pandemic is over, now the government cut down that route. So now again it came to the 1% of the NTTL. So this is the MSF. When the bank wants to borrow the money, it can use repo route, bank rate, or MSF route based on the necessity of the cash it wants. I hope the concept of repo, MSF, and reserve requirements and bank rate, these concepts are clear to you. Thanks for being with me. Have a great day.